Hey, Lyn, can you hear us?
Hear me?
Now we can, yeah. Thanks for being here today. So just before we start, a short introduction of Lyn. As most of you know her, but just in case, Lyn is a well-known macroeconomist in the crypto sphere. She's also part of Ego Debt Capital and on the advisory board of Swan. She has also a very good newsletter that is coming out bi-weekly. And of course, her book, Broken Money, which we have translated in Bulgarian, is coming out on the 15th of December, the latest. So yeah, once again, thanks for being here today. And our first question for you is, nothing stopped this train. This is something that you're posting on X quite a lot. And overall, just it's in your newsletters quite a lot. Could you explain in layman terms what you mean by the, I don't know, term or just general phrase that you're using on X?
Sure. So that's a reference to Breaking Bad. That nothing stops this train. And what I mean by it is that large fiscal deficits in the United States are going to continue for quite a while. They're above average, and there's very little probability of them being meaningfully reduced anytime in the near future. And this has a variety of macroeconomic and investing implications. Um, a lot of investors are very focused on the credit cycle or monetary policy. That's really been the guiding force for developed markets over the past 4 decades. But ever since about 2019, and then especially starting in 2020 with COVID, we've been in this higher nominal and percentage of GDP fiscal deficit framework, which has been surprising to a lot of investors because a lot of their tools or a lot of the things that they historically learned to focus on are actually kind of taking a back seat to the sheer amount of fiscal stimulus and pre-stimulus that's hitting the economy on a quarterly basis. And the relevant thing for crypto assets is that basically, the denominator is kind of in a sustained debasement mode, which, to some extent, it always has been. Fiat currency is always weakening. But basically, when you're running these high of structural deficits, that background level of debasement is faster. And so my general argument, like the key thing that I've been focusing on in my investing is that we're in a hotter nominal GDP and a hotter like nominal asset price environment than we would otherwise expect if we were running 3% of GDP deficits rather than 6 or 7% GDP deficits. And I think that investors of all types, whether it's TradFi or in this space, should be mindful of that fiscal impact in the economy because it's actually a lot more powerful than some of the monetary policy impacts that we historically see.
Thanks for that, Lyn. And the second one is with regards to your answer, just following up on it. How Bitcoin and the overall crypto sector are likely performing in a fiscally dominated world, as you said right now. And in one of your newsletters a while back, you said that the last cycle was in the midst of everything up cycle. I mean, the last crypto cycle was in the midst of everything up cycle post the high COVID stimulus. And now we're in a different world with higher rates and gradually increasing liquidity instead of having a large jumps in liquidity. How do you see this cycle play out from a liquidity point of view? Bitcoin versus L1s such as Ethereum and Solana versus other altcoins. How can you imagine it?
Yeah, good question. So if you back up for a second, the reason that U.S. deficits matter even globally is partially because of how big of an economy the United States is. So when we look around the world for different types of stimulus, the United States, China, and then a handful of others, the ECB or Japan, these tend to be globally impactful when they make pretty big changes. And so the U.S. deficits, the nothing stops this train meme is not just a US phenomenon, it has global implications. Historically, if the US runs big fiscal deficits but has tight monetary policy, like we saw, for example, in 2022 and 2023, that tends to be, ironically, a strong dollar environment, which can impact a lot of emerging markets and slow them down because they have dollar denominated debt. On the other hand, if you're running pretty hot fiscal, but then you're also supporting it with monetary weak like dovishness, that tends to be very stimulative across the board. That's what we saw in 2020 and 2021. And so to get to your question, 2020 and 2021 were kind of like everything up. Like almost every asset is up. Um, whether it's high quality stocks, whether it's like for example ARC type stocks, like unprofitable but innovative companies, they were soaring. Um, uh, Bitcoin, altcoins across the board, everything's basically up in 2020, 2021. Um, and what I think characterizes this current and next cycle is a differentiation in quality. So, for example, we've seen a rebounding in a lot of high quality equities, but we've not really seen a rebounding in unprofitable equities. There's not a lot of investor appetite for companies that are not making money. In an environment where yields, on a lot of traditional assets are like 4 or 5%. There's actually a cost of capital, and so there's more of an investor preference toward things that are quality. Um, and so I think what you want to be focused on is in the broad crypto space is things that are actually quality. In this cycle, there has been like a meme cycle, but that's not really new retail coming in. That's like existing kind of PvP entities playing around. And I think that this cycle is going to be probably more dominated by larger pools of capital, so institutions coming in. And then to the extent that we get retail back into the space, probably after fresh new all-time highs, um, I don't think you're going to see the indiscriminate buying across the board. And I think there's going to be an emphasis on quality. So the things I tend to focus on are Bitcoin and then stable coins, which are obviously not really investable, but you can look at the rails that they run on and that kind of thing. And real world assets, things that are actually solving problems and expanding markets is how I tend to view the space primarily. I think there's more of an emphasis on not just speculation in this cycle, but on what is actually solving on the ground problems for people in various countries.
So the bigger the problem, the better the payoff.
So if I may
Yes.
just jump in here. So are you saying that you don't expect, Lyn, that we have like the similar type of rallies that we saw like in the last two cycles of various altcoin coins, and that the growth from your perspective would be mostly focused on Bitcoin, let's say, and stable coins as a just a size?
I think it depends on whether or not there's a new tech narrative. So each of those cycles, one was a liquidity cycle. So I've done research showing that the whole space is pretty correlated with measures of global liquidity. So what they tend to have in common, like the 2017 cycle, even earlier cycles, but let's say the last two cycles, 2017 and 2021, they were positive liquidity cycles. But then also there were tech narratives in the space. Whether it's ICOs, DeFi, NFTs, each one had these kind of like leading narratives that eventually kind of saturated itself. It kind of hit a peak period of speculation. And then eventually kind of subsided and was no longer like the main character narrative. So I think whether or not we get a broader rally in the space will partially depend on whether there's a narrative that's similar in scale to those. Um, and at the current time, I don't really see a narrative like that, other than maybe real world assets. But that it's kind of inherently less speculative in a way. Obviously, people can speculate on which rails will win markets like that, and people can place their bets accordingly. And even, I mean, stable coins are a type of real world asset. Essentially, it's kind of the original real world asset. Is taking a dollar and putting it on the blockchain. Um, and so I tend to be focused on those utility questions. Um, and so I probably the people here would be better than me at speculating on the next say non-Bitcoin narrative in the broader space. But the thing I would bring from a macro perspective is to say that the monetary and fiscal environment is probably less supportive of speculation in this upcoming cycle, and that it's more differentiating between what is actually solving a problem versus what is not.
Thanks. You said that this cycle is influenced by larger pools of capital relative to previous cycles. Hence, are ETFs a net positive or a net negative for BTC and ETH? And is there a difference between them as in what they mean for the market, and what's BlackRock's impact on the market overall?
So I view the a lot of people ask if it's good or bad. I step back and say, first of all, it's inevitable. Any asset that gets sufficiently large and liquid is going to have ETFs for it. Um, that's basically like the fiat system's API for plugging into it. That's just how they plug in. Um, and so if any asset can't handle ETFs being made for it, like if that's a problem, then that asset was never really useful to begin with. That's like a fairly low hurdle rate that an asset has to step over to be globally relevant. So on average, I view it as a net positive because it basically just means that there were large pools of capital that wanted to be in, but didn't have a regulatory or functional way to get into the space earlier. And so you had to use inefficient proxies like Grayscale, where in addition to being prone to the price of the asset, you were also focused on is the premium going to turn into a discount, or how deep can the discount get? Can the discount ever be resolved with like redemptions of any sort? And that of course blew a lot of people up in the past cycle when people were leveraged based on that issue. So you could argue that if spot ETFs came earlier, the last cycle could have been less damaging for people in the space. And then there are pools of capital that, like for example, they can't even buy like a Bitcoin ETF. They can only buy like there are large pools of capital that can only buy stocks like companies, or can only buy bonds. Right now, the main entity filling that role is MicroStrategy. So if you're a stock, and if you run a stock fund and you happen to be bullish on either Bitcoin or the space, um, one of the only avenues they can express that view is either the miners or MicroStrategy. Currently, there's not that many ways for them to express bullishness on the rest of the space. There's not really like that companies that are heavily engaged. Maybe Coinbase is probably the best way they could express that. Um, and then same for bonds. So MicroStrategies, for example, issuing bonds, convertible bonds. So if you happen to be a bond investor that happens to like the space, that's one of the avenues that they can express it. And the high premium to NAV shows that there's a lot of built up demand among institutions for these types of products. And so when we come back to the spot ETFs, basically there's pent up demand for these assets, and now that's being met. Um, and there's a centralizing force to some extent, but a lot of it is just rotation. So we've seen, for example, GBTC had over 600,000 coins. Um, that a lot of that drained into the other ETFs. There's now more coins in total in the ETFs than there were in Grayscale, but not by a huge amount. It only went up by a few 100,000 coins, and the price increase associated with that was pretty large. And so, to the extent that you'd get another few 100,000 coins into these entities, it probably would come with pretty big price increases, and therefore it'd be harder for them to kind of capture a very big percentage of the market. So I'm not that concerned about it, even though it's something I'm monitoring. Um, as for how it impacts different assets, I have a little bit more concerns around how large holdings of an asset will impact proof of stake networks versus proof of work networks. Um, but that still remains to be seen. And then it's also possible that because the current regulatory environment doesn't allow staking yields in the ETFs, that could slow down the attractiveness of those products compared to if we get products where the staking yield can be part of the total return environment.
Yeah, we'll see. I guess it will develop over time. But coming to the US, as it's an impactful country on our lives, whether we like it or not, all over the world, especially in finance, what will a Trump or a Harris win mean? And isn't it better for Bitcoin to have an adversarial overall government in the longer run instead of having a crypto friendly one? Uh, just generally because of the nature of Bitcoin and why is it created?
So I think it depends. I mean, you don't want adversaries for the sake of adversaries, but you probably you want your system to be battle tested. So I think it's good to have allies. Like the fact that El Salvador made Bitcoin legal tender, I think is a good thing. It's not like it's a smaller country, but it's useful to have little safe havens around the world that are supportive, even if you have maybe some larger entities push back on it. I think, unfortunately, whether you get a Harris win or a Trump win, I don't really see the U.S. Privacy situation improving anytime soon. So the U.S. Financial establishment has a very anti-privacy framework, and so whether it's Tornado Cash, whether it's Samurai Whirlpool, whether it's mixers in general, now I mean the fact that they're even like that they've kind of established their precedent of going after non-custodial privacy solutions is super concerning, and I don't really see that likely changing in the next 4 years. Maybe around the margins, it could determine how aggressive they are. But this has been ongoing through multiple administrations, and a lot of it is not really direct policies of the president. It's just kind of like this part of the machine is against it. And I think that, for better or worse, I would consider it worse. I think these anti-privacy policies, regulations, prosecutions are going to continue. So you're going to have an adversarial environment on that side, and therefore there's still an ongoing need for any sort of cypherpunk development across the board. I think the main area where a Trump versus Harris election matters for this space is mostly in the crypto securities, like mostly in the SEC type of stuff. Like what is allowed to exist without being heavily fined or gone after in some significant way. Like what can you tokenize? What can you sell to the public? I think that's probably where this election has the biggest impact for the industry. Whereas like the deeper stuff, like the privacy, some of the core reasons to it exist, I think are still going to be pushed back on, probably.
Yeah, and Lynn, speaking about the privacy, I'm curious to follow up. Like, since you obviously one of your major endeavors is the Ego Debt Capital Venture Capital Fund. Since you see this is a very big issue, regardless of what the outcome will be of the election, do you yourself, as an investor and as an investing group, look into such privacy-focused solutions? Solutions? Have you maybe invested in such, or are you looking for such ideas in general?
So we have basically, so the challenging thing with privacy, like in this whole space, the more cypherpunk you get, generally the less investable it is. And the less cypherpunk you get, the more investable it is. So if you have a big KYC exchange, that's a very investable thing. Whereas like peer-to-peer trading or privacy tech tends to be a smaller market and a riskier market from a regulatory perspective. Um, we have invested in, for example, Chalmy and eCash companies. So that's basically taking a 40-year-old privacy tech and then putting it on top of say Bitcoin or stablecoins, that kind of thing. So that's an area we've been interested in. And some of our companies, just by their nature, um, some of them are privacy focused, other ones are not. Um, I think one of the best ways to fund privacy is actually grants rather than investing. So in addition to investing in the space in for-profit companies that are, venture companies, I donate to like the Human Rights Foundation and other entities that are trying to support whether it's research, whether it's development, whether it's education, supporting kind of privacy tech or just anything kind of touching Bitcoin, stable coins, that whole space, because some of that doesn't flourish in a for-profit company, and some of them are NIMS. Like some of the developers are NIMS in the privacy space for their own protection. Um, and to the extent like I can meet some of them in person and still not know their names. And so they build reputations that become fundable uh, with grants, and less so for wanting to be associated with a for-profit company. So there are, I would say, there, kind of answering your question, I would say there are privacy tech things that are investable, but probably the broader space is more grantable, which is to say that a lot of privacy tech is probably a little bit below the surface for what is super financeable from a for-profit perspective, and that grants kind of fill that gap because it's basically saying that like it's something that you want to exist even though it either doesn't make money or is probably best incentivized by not making money, or is not at a scale or regulatory clarity that it could make money, but that you think it's good for the ecosystem for it to exist.
And then in terms of the more investable stuff, I'm curious, like also because in this conference, we have a lot of builders, right, who are looking to solve actual problems. Maybe if you can, like on top of your head, maybe one or two kind of big problems that you as yourself and as an investor group are looking maybe for potential solutions, and so potential companies that are addressing these issues. Can you share some of? Do you have such in mind?
Sure. So one of the themes I look at is not reinventing the wheel, but applying the wheel to more locations. So if we know that certain companies are successful in big, large markets, the United States, parts of Europe, and elsewhere, then the question is, well, can you apply that similar concept in India? Can you apply that similar concept in Brazil? Can you apply that similar concept in countries across the world, any sufficiently large market, to make sure one is that more people have access to it, and then two, because it's potentially an untapped opportunity that is proven in another market. So even basic things like exchanges or brokers are still investable, because it's taking a proven model and just kind of making sure that there's other markets that have access to high quality versions of those, um, and that are specialized to that market. And so that's one of our areas. And then two is any sort of like infrastructure, that makes interacting with the assets easier. Anything that makes touching Bitcoin or stable coins or things like that easier. Um, I'm also bullish on anything that can bring real world assets to more people. Um, and so I think those are the themes that I would be kind of focused on is, and of course there's like a different series of S curves that happen here where right now the medium of exchange use outside of stablecoins is still fairly small. Stablecoins have captured a lot of that market because if you're exchanging things rapidly, you don't really want volatility, you don't really want capital gains taxes, and so stablecoins have been really powerful for that use case. Store of value has been pretty heavily in the Bitcoin side, like long term store of value, and then the question is what other is capturable. Um, and so that's kind of how I approach it.
All right, thanks for that. Cool. And so I have this one, like actually two more questions, but one is going to be a little more focused here on our environment here in Bulgaria. So in our prior conversation, I mentioned to you that we currently, as a country, have our own currency, which is pegged to the euro, right? And we have this large discussion, ongoing public discussion that's been going for the last 2, 3, well, maybe even more years, as to whether we should join the eurozone actually, or we should just keep it as it has been, just having our local currency being pegged to the euro. So it would be very valuable for us to hear your kind of thoughts on the eurozone in particular, if you feel like sharing in our situation, if you are aware, but on the eurozone in general, what's your outlook? From the perspective, obviously, with all your macroeconomic experience and thought leadership.
So I've been fairly critical of the eurozone. Basically, the idea of a monetary union without a fiscal union, is a challenging concept. Um, if we look at how U.S. states work, most of the debt is on the federal level, and like the retirement systems and all that. That's where a lot of the debt is, all the entitlement stuff. A lot of that's on the federal level, um, not the state level. There's some on the state level, but when you look at, say, state debt to GDP, like state debt relative to state GDP, that tends to be quite low. Most of that's elevated to the fiscal, like the national level. Whereas in Europe, the fact that you have all these, you can kind of classify the different countries as like being really large states, in this kind of broader union, for financial purposes, and the debt is all on their local level. It's all on the country level, even though they don't control their own currency, and that just greatly complicates managing that whole arrangement. So, for example, you have Italy and Germany have very different requirements for ECB support, for example. And then in practice, we've not really seen that like not joining the eurozone holds countries back. I mean, like the catch up that Poland has done relative to the languishing of a number of eurozone countries like Italy and others, economy wise, shows that I generally view retaining their own policies as probably being the baseline. I think there has to be a pretty strong argument for why a country would want to give up that capacity and join this broader union, and give up the agency that they have from their own currency. Um, pegging is obviously a solution that can make things simpler, but they still retain their own kind of ultimate their ultimate agency. So I'm generally, if any country that I was involved with, I would personally not really want it to join the eurozone. And I make a similar argument when people say that it's going to be like a shared BRICS currency. The different BRICS countries, they have less in common with each other than even the eurozone countries. Um, a lot of BRICS countries don't even particularly like each other, from a political standpoint, and yet they have kind of a practical joining because of a lot of shared interests. Um, and I generally view that they're going to evolve with more and more bilateral trade agreements, maybe even potential shared reserve assets on kind of the sovereign level that they can trade around, but not an actual shared currency. Because I think that the eurozone has showed that that's not really been a strong path.
Okay, and as a last question before we open this to the audience, maybe if they have some questions to ask. But obviously the reason, the initial reason for us having this conversation is the translation of your book in Bulgarian. Last year, about a year ago, Kostadin reached out to me because I've been translating a few other books about Bitcoin in Bulgarian, and he said like, we really have to translate this book and make it available in our country. Um, and for our audience here, I want to ask you, why did you write this book? Since there's so many already other books, right, about money, about Bitcoin in general. Why did you feel the need to write this book, and who is this book really for?
So I was resistant to writing a book for a long time because it's a very tedious process and generally low ROI compared to other things you can be doing. And so I didn't write a book until like this specific book kind of came into my head, that there were certain theses I wanted to express in a long form complete package, and it became distracting for me not to write the book, so I kind of had to write the book. And it became like a passion project for that entire year. um, and so what I kind of, the niche that I generally found was that there are a lot of books on the space that are short or mid-length, and I thought that there was space for a really comprehensive one that kind of like started at like really early first principles. Like literally, the book starts out with like hunter gatherers money, um, and works its way up to the modern era. In addition, I generally found that in books on finance in general, there was like when you look at any book on monetary history, often it's about the history or the politics of money, and there's not as big of a focus on how technology changes money. So, for example, the introduction of the telegraph um, was a massive game changer for money, how money works, and yet you don't really see that discussed very often. And of course, the same thing with the internet and other things like that. So, how does improving technology impact either what we use as money, or who controls the money, or how what kind of layers that we use to interact with that money? And so, I wanted to explore how over literally centuries, or in some cases even longer, how changing technology changes how we interact with money. And so in that book, the digital assets don't even really come up until the final third, because the first two thirds are like, let's establish a foundation of what is money, how has money evolved over time, what is finance, how has that evolved over time, how is all of it shaped by technology, and then it gets into the modern era and says, okay, now what can we imply from this going forward? Um, as for a target audience, it's basically anyone who's interested in this space. Um, it's on the longer side of books, but it's very accessible and modular. Is how I approached it, which is to say that it's long books can be kind of intimidating, but if you make it so that they're readable page turners, then the length doesn't, in practice, feel as long as it is. In addition, I've generally found that it's a lot of institutional type of investors like it. It's written in language that works for them. And so there'll be fund managers that give the book to their other fund managers or people in their organization. So whether it's professionals or whether it's a retail audience, that's really kind of how the book is targeted. Anyone who really wants a foundational understanding of money, finance, and then extending into digital assets.
Absolutely. Thank you so much. I think this is so necessary as a base of knowledge that many people take for granted that they have, and that I think it's not really the case. So sharing my appreciation for the work you have done and the work that we're bringing here to Bulgaria. Okay, having said that, we're going to open it up in case people in the audience have any questions.
You can go to the mic that Vladi has.
I want to get you to ask you two macro questions. With that amount of fiscal spending in the US, do you think that getting a recession is really possible in the US? And the second one is how probable do you think that we get a second wave of inflation? Thank you.
Yeah, good set of questions. I generally view that the large fiscal spending reduces the chance of a recession. And then to the extent that we do get a recession, it would probably look different than the average recession, which is to say it would probably be in some ways more like an emerging market recession. The general thing is that emerging market recessions tend to be more like currency crises rather than unemployment cycles. Whereas in the U.S., recession is generally characterized by an unemployment cycle. And I think this kind of structurally running hot environment probably softens recessions, but then makes them on average less disinflationary. So to your question around if we get a second wave of inflation, I view it somewhat as one. I think that the background inflationary baseline is going to be higher than the 2010s decade because of this fiscal support. And then whether or not we get a true wave of inflation, I think will partially depend on two things. One is energy, right? So the prior inflation wave was partially tied to energy prices, not entirely, but it's hard to get really high sustained inflation when energy is abundant. Um, so as long as China domestic energy consumption is fairly modest, which it is right now because they have a very strong export economy, but they have a very pretty weak domestic economy right now. And as long as OPEC has significant spare capacity and there's no major war disruptions to energy flows, that keeps that in check for at least a while. But whenever we do get energy, shortages, either because demand picks up really quickly or because supply is impaired, that would be inflationary. And then the other one is a credit cycle. So if we get right over the past few years, both in the US and globally, um, credit has been pretty sluggish, which is to say that because rates are pretty high and central banks are trying to be hawkish, they've slowed down the growth of private credit. And it's been somewhat softened by all of that fiscal deficits. But we're seeing kind of early signs that we're probably past the peak of credit tightness, and we could see another positive credit cycle, which is that more entities taking out private debt, basically, on top of this fiscal environment. Um, and so I think that whether or not we get an inflation cycle will partially depend on China and U.S. fiscal policies, the credit cycle, and energy. So I think that my base case is just stickier above target inflation, and I would call for a second wave of inflation only when I saw more tangible likelihood of a credit cycle or energy shortages.
Hello, Lyn. Nice talking to you. So my question is about payments adoption as a whole. I would like to divide them into three categories. So USDT adoption on turn for developing countries with high inflation, the Lightning Network on Bitcoin for more developed countries, and the rest of the crypto space. So in your opinion, is the rest of the crypto space lacking in terms of payments adoption? And how valuable is payments adoption, in your opinion, compared to the other problems that the crypto space is trying to solve, like bringing traditional finance on chain?
So I think that payments are important, but still like a fairly small market compared to the rest of the space outside of stablecoins. I mean, one of the earliest use cases for any of this was payments. Like when WikiLeaks, got blocked out of PayPal and others, kind of before Bitcoin even had a price. It was one of the mechanisms for how people could still donate to it, um, and keep it, running. So that kind of permissionless payments is a key feature of this space. Um, Even though it's not necessarily a huge market in terms of what people are using it for now, in terms of store of value or DeFi or stablecoins. Um, I think for a lot of people's use cases, kind of short-term working capital and exchanging value, stablecoins fill the gap for non-sanctioned countries, and things like that. Um, that probably persists for another several years. I mean, eventually you can get to a point where even the dollar itself runs into problems. But right now, because there's so much global, dollar denominated debt, demand for dollars, and fairly low volatility of the dollar, I generally see stablecoins unless the U.S. decides that they don't like the existence of stablecoins, which so far they've been moderately supportive of them. I generally expect the stablecoin market to keep kind of dominating that market for a while. Um, and the other ones are more about optionality. So like the Lightning Network is still small, but the fact that, one of the use cases of Bitcoin is that you have your own global capital, and almost any urban center you go in the world, you can eventually find ways to exchange your Bitcoin for local value, whether it's exchanging it for the local currency or exchanging it for goods and services directly. That's something you can do with the asset that you can't do with like an ETF or a share of the S&P 500 or something like that. It's a bearer asset that the fact that you can offload it in a variety of different markets for direct or indirect purchasing is a key feature. Um, and I expect that for most networks, including Bitcoin, um, the payments is probably going to be kind of a friction-filled market for a while. That's where a lot of the regulations are against that. Um, that's where privacy is super useful. Like you don't want, like if you withdraw an asset from Coinbase, you don't really want Coinbase then watching everything you spend it on. You generally want privacy. And so a lot of people, when they think of privacy, they think of privacy from the government, but it also means privacy from other entities, like corporations, spying on you. And because there's whether it's Europe, whether it's the U.S., there's a lot of anti-privacy frictions. I think that that's just that's one of the hardest part of the markets to operate in compared to store of value or financial systems. The actual payments thing is the most regulatory hurdle, and then outside of stablecoins, so far currently a smaller market. So I think it's important. Like I think it's there's a gap between how important it is for that space to continue to be developed and continue to grow and be adopted versus where we are in the cycle and where the regulatory attacks are and the size of the market.
Okay, thanks. Next question there on the back.
Yes, Lyn, thank you very much for your time and attention. Always instructive and informative, so that's great. You've talked about the U.S. election. I'd like to turn your attention to rising tensions in the world, particularly given your background in Egypt. How do you view the situation in the Middle East? Egypt borders Israel and the rising tensions there. If you could put a macroeconomic lens on tensions, rising tensions.
Good question. And for context, for people that don't know, I live part of each year in Egypt. It's kind of my second home. Um, and so it gives me kind of an experience in that region. Um, you know, like the way that Egypt's approaching this is they're trying to like avoid direct conflict. Ironically, one of the most impacted countries by all of this is Egypt because of the impact on the Suez Canal, the safety of the Red Sea, and the dollar flows that they get from that. So ironically, as Israel and Palestine and Iran and Houthi rebels and Lebanon, as they all go at it, one of the most impacted economically has been Egypt, even though they're trying to stay out of it. Um, and I think that a lot like this is obviously it's massively impactful for any people in the region that are directly affected. I mean, it's a human human rights crisis. There's just war is a horrible thing. Whether it's in Eastern Europe, whether it's in the Middle East, the fact that these wars are going on are massive human conflicts. To the extent that they're relevant for global investors or from a macroeconomic standpoint, the key question to start with is, what are the probabilities of impacting oil flows? Whether it's Iran sanctions, whether it's a tax between countries on energy infrastructure, that kind of thing. That's a really big factor to monitor. And then two, in general, war is inflationary. So when we think of inflation, the baseline's not zero; it's negative, right? So if you have 7% currency growth and inflation is 2 or 3%, what that means is you have basically like 4 or more percent of annual productivity growth, which is that you're getting better at making things and distributing things. So, for example, we're better at making electronics or clothes or um, a bunch of things than we were 20 years ago. And part of that is because of automation. Part of that is because of globalization. And so things that detract from that, things that blow things up or make supply chains people realize that maybe our supply chains are too spread out. We optimize efficiency over resiliency. And so any shift back toward resiliency tends to be inflationary. It kind of means you're not optimizing. If you had a perfectly peaceful world and every country was happy with each other, you could have this like really fragile supply chain that is hyper efficient. But then to the extent that you have the risk of countries cutting each other off or adding tariffs or doing outright war, it means that you have to think about the resiliency of your supply chains at the cost of efficiency. And then you get this higher kind of baseline inflation. Or to put another way, you get less disinflation, even though we still, we have better automation, but then we have, kind of more duplicative supply chains or more supply chains that are closer to us that are maybe not optimizing for cheapness. I think the energy and supply chains are where this matters from a global standpoint, and then obviously the regions themselves. It's a human crisis.
Thanks for that. We have a few more minutes, and we're going to have 3 more questions. Is that okay with you, Lyn?
Yes, that's fine.
Thank you. I appreciate it. So next question, please.
Hey, Lyn, can you hear me?
Yes, I hear you.
Thanks for the presentation. So I have a question for you. I understand now that your take on inflation that can come from credit cycles or also energy, but I wanted to get your take on this argument. What if, and I understand that fiscal policy for you is more, it looks like more important now than monetary policy, and I would say that even the federal government admits that sometimes. So I would like to get your take on the argument that lowering rates is actually deflationary and not inflationary, if everything else the same.
Yeah, it's a good question, and this is a concept I've explored to varying degrees, including in the other direction. Are higher rates, less disinflationary than we expect? And I argue that in general, when you have higher public debts, interest rates are less effective in both directions at dealing with inflation. So if you go back to the 70s, to use the U.S. as an example, most of the money creation was from bank lending, and there were fiscal deficits, but they were smaller. And public debt to GDP was only 30%. So if they raise rates, it slows down bank lending more than it blows out the deficit. Whereas if you fast forward to the modern period, where the U.S. is like over 120% debt to GDP, when they raise rates, it does slow down bank lending, but then it actually blows out the fiscal deficit by a bigger absolute dollar amount than it slows down bank lending. And it becomes somewhat less disinflationary than you'd expect from high interest rates. The same thing's true for Japan, even more true, because they're even deeper into fiscal dominance. Europe, it depends on the country. and then there's the eurozone as a whole. But in general, that's probably more mixed in terms of whether high rates are inflationary or disinflationary. The complicated part is that we have to look at the global perspective. So because a lot of countries in the world, especially emerging markets, have dollar-denominated debt, the interest rate policy affects them. And the majority of global population lives in what is classified as developing countries, and that's where the marginal global GDP growth comes from now, including some of the inflationary effects. So when a highly developed country has GDP growth, it tends not to be very commodity intensive. Whereas when a country with lower per capita GDP has GDP growth, that tends to be more directly commodity bullish, because there's lower per capita use to begin with. There's a much higher floor of potential growth in direct commodity usage. And so when you have a strong dollar, whether it's because of aggressive fiscal or tight monetary policy, that tends to weigh down and hurt the liquidity of a number of different emerging markets. So to the extent that rate cuts are inflationary or disinflationary, I'm somewhat in the middle on that. It depends on what else is going on. But in general, I think that mild rate cuts are probably inflationary in the sense that they relieve some of the debt burdens, or they ease some of the liquidity constraints of emerging markets, and allows them to kind of potentially have a credit cycle. So I think that interest rates are probably less impactful for inflation than a lot of people think, because of how far we are into this debt cycle. And instead, it's questions like, what is the size of the fiscal deficit, and then what is the rate of credit growth, which is only partially affected by the rates.
Thanks a lot. She wrote a very in-depth newsletter about this, I think 6 months ago. So if you have time, you can read it on her newsletter. We have another question. Yeah.
Hi, Lyn. Thank you for taking our questions. Taking into consideration the environment of lowering interest rates, for example, ECB has just lowered for the second time this year its interest rates, and also the expectation for lowering interest rates in the US to the end of the year. Also the factor that this is an election year, so the next year will be post-election year. Taking all those considerations in mind, what is your expectation for the next year? Because when there is a notion that after a tightening cycle, when interest rates start coming down, that means that there is something broken in the economy, and it needs a little push and stimulus, and also the fact that it's a post-election year. What is your general outlook for the next year? Do you think it's like more bullish or bearish? Just your thoughts on that topic. Thank you.
I generally view it as probably more bullish, and I'm looking for global leadership rather than like U.S. economic leadership. So rather than kind of the U.S. pulling the world along, I think that kind of like the 2001 to 2007 cycle, that was a period where non-U.S. entities were kind of ahead and pulling the U.S. along. So I think that's a realistic possibility of the next few years, which is that the U.S. kind of softens or doesn't particularly flourish per se. But that the fact that a lot of countries have gotten through a tightening cycle and are now able to ease can allow kind of like BRICS-led growth, or just general global-led growth compared to the U.S. That's kind of what I'm somewhat watching. That's why I think that China, actions out of China are probably equally important as actions out of the U.S. A key things to watch in the next year in the U.S. are, one is that some of the tax cuts that Trump did in his term are set to expire, and while I don't really expect U.S. policymakers to directly kind of reduce the deficits much, um, these things that are automatically set to expire are kind of one of the few ways where you could get actually a little bit of deficit reduction. And that partially depends on who wins and then how they manage it when they win. And so I think that's probably one of the kind of the Boolean outcomes to watch is what happens with some of those tax cuts. Because if you do get a little bit tighter fiscal policy in the U.S., that can have global implications, whether it's through the dollar or whether it's through U.S. consumption from the rest of the world. And so I think that's a key thing to watch. But other than kind of like that variable, I tend to have a pro liquidity view for 2025, and I think that a lot of that is basically that fiscal's still going to be a pretty big background force in the U.S. and some other countries. And then we might have a more positive credit cycle on top of that, in contrast to the last 2+ years of a very sluggish credit cycle.
I appreciate it. And last question there from Bobby.
My question is, what's your opinion on the following discrepancy? The S&P 500 and gold have been in a very significant uptrends this year, while Bitcoin has been consolidating for the past 7-8 months.
I think it's because the ETFs pulled forward demand. I think basically Bitcoin got overbought in March, effectively, and that pulled forward demand. People had very elevated expectations. If you look at like year-to-date returns, Bitcoin's been very strong, even though all of that growth happened between January and March, and it's been consolidating since then. We generally see there's some selling pressure from existing holders. There's buying pressure from ETFs and entities like MicroStrategy. I think we're slowly building out of the space, is my expectation. So if people ask me, do I think it's more likely that Bitcoin breaks out of the space or breaks down from this base? I think it's much more likely that we break out to the upside from this base, whether it's later this year, depending on election outcomes, or whether it's 2025. I tend to think that we're going to break out of this, but I think that right now it's a bullish asset. It's just that some of that like artificial demand was pulled forward, and that's one of the biggest headwinds against it. But I think that we've kind of gotten to the point where we worked through that. We kind of worked through some of that accelerated expectations, kind of renormalized. And a key metric that I look at is market value versus realized value. And you can apply that to any asset if you have the data for it, which is to say the market cap compared to what is effectively the on-chain cost basis, or the aggregate dollar value of coins, not based on the last time they moved. And generally, whenever you get a high market value compared to that cost basis, you're more prone to corrections, because some of that inflated value is not real yet. It's not really been actualized and traded around with high volumes at that price. And so even though Bitcoin is roughly priced how it was in 2021, the bullish case is that the cost basis is now much higher. I would argue kind of the floor of how people treat it is higher. So back then, even though the market cap got over $1 trillion in 2021, the on-chain cost basis was something like 350 billion. Whereas now, at the current time, we have a similar market value, but the on-chain cost basis is something approaching 650 billion. So you have that less of like inflated multiple of market value to realized value. And then even in this current period since March, even in this consolidation, the on-chain cost basis has increased from something like 520 billion to like 640 plus billion. So I think the floor is kind of keeps elevating, is how I view it. So the short answer is I think that discrepancy is caused by ETFs pulling forward demand, and that I think that we're kind of in a consolidation until we eventually break out.
Thanks for that. I have just last 3 things to say. First, I want to thank you joining us today and allowing us to translate your book. I know I've been one of the most annoying people in your inbox for the last 3 months, but I was persistent. And thanks for George is also agreeing to do this, and Vladi for organizing this whole event. Just a big round of applause for you and for George and everybody else.
Thanks, everyone.
Yeah, just last but not least, buy Lyn's book. That's it. Thank you, guys.